Hello, everybody. Welcome to the Odyssey of Virtual Learning. Let us begin our Odyssey with a new chapter, a new topic, namely working capital. Dear students, we all know that a company or a business firm cannot be started without capital, and capital can be divided into two parts: fixed capital and working capital. Fixed capital is basically required for purchasing of fixed assets for a long term need of a business, whereas working capital is required for meeting the day to day expenses of the business. Let us explore more on working capital. In an ordinary sense, working capital denotes the amount of funds needed for meeting day to day operations of a concern. This is related to short term assets and short term sources of financing. Hence, it deals with both assets and liabilities in the sense of managing working capital. We can say that it is the excess of current assets over current liabilities. It refers to that capital which is needed to finance current assets or short term assets like cash, debtors, inventories, etc. Money invested in the current assets keeps on revolving fast and are constantly converted into cash. This cash is again it flows out in exchange of other current assets. So it's a cycle. So basically, if we are going to define working capital, we can say that in the words of Mead, Baker, and Mallet, working capital means current assets. And according to J.S. Mill, the sum of current assets is the working capital of a business. Let us know more about it. Let us know what are the concepts of working capital. Basically, we can say that there are two concepts of working capital. One is balance sheet concept. Balance sheet concept again is of two types. One is net working capital concept, the other one is gross working capital concept. And again, we can say or we can understand working capital under operating cycle concept. Now, what is this operating cycle concept? According to this concept, working capital is nothing but it is the current assets of the company that are changed from one form to another in the ordinary course of business. That means the current assets changes its form. That means from cash it get converted into inventory, from inventory it get converted into work in progress, from work in progress to finished goods, and from finished goods to receivables, and finally from receivables to cash. So we can say that this there is an operating cycle, you know, when whenever you are buying the raw material you need the cash, and again the raw material you purchase get converted into the work in progress converted into finished goods, finished goods once sold on credit then it leads to accounts receivable, and when you collect the cash, accounts receivable to cash. Okay, and then finally this cash is again used for purchasing the raw material. So this is nothing but an operating cycle. Operating cycle is nothing but the time gap between the sales and actual realization of cash from the sales proceed. How much time does it need to take the cycle? Accordingly, you need to manage your funds for meeting the day to day expenses. That is what is all about the working capital under the operating cycle concept. Okay, this is exactly what we have read now. Now, according to the balance sheet concept, we have read that according to the balance sheet concept, it can be net working capital, it can be gross working capital. What is this net working capital? Net working capital is the excess of current assets over current liability. By way of formula, if you are going to write, then net working capital is equal to current assets minus current liability. And what is the gross working capital? Gross working capital is nothing but it is the total current assets or gross current assets. That means sum total of all the current assets will be said to be the gross working capital. So, gross working capital is equal to total current assets. The balance sheet definition of working capital is important as it indicates the firm's current solvency position in repaying its creditor. So, whether a firm is liquid or not, it's able to meet its short term obligations or not, is something which can be known from the balance sheet concept of the working capital. Operating cycle is also equal to the length of the inventory and receivable conversion period. It is important that the company must invest in inventories to fill customers' order promptly. The company also needs to invest in accounts receivable to extend the credit to customers. So, working capital is also termed as revolving or circulating capital, or we can also say that it is known as the short term capital. Okay, now let us read the components of working capital. We have already read that working capital is nothing but excess of current assets of current liabilities. Now, what do the current assets include? Current assets include the raw materials, the work in progress, finished goods, stock, the inventory, the prepaid advances, cash and the bank balances, sundry debtors, and you have got short term deposits below 1 year. And the current liabilities consist of short term creditors, bank overdraft, short term borrowings, proposed dividend, short term loans and advances, accrued expenses, and many more, right? With this, I come to an end to the concept of working capital. Thank you. We'll meet again in my next video.